we have talked about if there's an intra-entity inventory transfer, what to do on the parent's book. And now let's look at the consolidation entries. There are three consolidation entries: consolidation entry TI, consolidation entry G, and consolidation entry star G. So consolidation entry star G is only for the subsequent period, versus consolidation entry TI and G that can appear in all periods. We're going to look at each of them. Specifically, in today's class, we're going to cover consolidation entry TI and G. And in the next class, we're going to talk about consolidation entry star G. So consolidation entry TI, the purpose TI stands for transfer of inventory. The purpose is to eliminate the effect of intra-entity transfer of inventory. And the journal entry is to debit sales, credit cost of goods sold. So I'm going to explain it using examples later. I'm going to explain this journal entry using examples later. But one thing I want you to notice here is for consolidation entry TI, is there any effect on the profit here? Or in other words, does the firm's net income change as a result of this consolidation entry? So it doesn't change, right? Where debit a certain amount for sales and credit the same amount for cost of goods sold. So as a result, the net income does not change. But what changed with this consolidation entry? What changed is the sales were able to get sales down and get cost of goods sold down. So maybe you can imagine that the purpose of this consolidation entry, if we have inflated sales and inflated cost of goods sold, this consolidation entry will work to get those back to what should be if we view two firms as one firm. But it doesn't have any effect on net income. Consolidation entry G, G stands for gross profit. And the purpose of consolidation entry G is to eliminate unrealized gross profit created by intra-entity sale. So the entry here is to debit cost of goods sold, credit inventory account. So as you can see here, does this entry affect your net income? The answer is yes. So we are affecting your net income through actually bringing up cost of goods sold. So your net income, if there's any inflated profit, we're actually using this entry to defer, to take out that profit, or in other words, to defer that profit. So your net income will go down as a result of this consolidation entry. And also we credit inventory, your inventory will go down accordingly as well. So those are consolidation entry TI and G. And I'm going to use three examples to explain those two consolidation entries. First, let's look at an example of, so we have two firms here. Arlington is the parent and Zirkin is the subsidiary. Maybe. $1,000. And Zirkin sold all of the inventory to outside party for 100,000. So this is the setting of this example. And this is an example of all inventory sold externally. So all of this 80,000 is sold to the external party at the end of the year. And please take 15 minutes, try to work on this example. Answer these four questions. The first one is, because both Arlington and Zirkin are individual firms, them as one firm, what should be the journal entry to record the transaction? And then the last one is what should be the consolidation entry to eliminate the effect of intra-entity transfer of inventory? Please take 15 minutes, try to think about it and try to work on it on your own. You can pause your video for now. So let's look at on Arlington's book, we have Arlington, we have Zirkin, and we have Arlington plus Zirkin. On Arlington's book, what are the journal entries Arlingtons are making? So Arlington sold the inventory to Zirkin. So on Arlington's book, it is going to record, it is getting cash of 80,000. At the same time, it is making sales of 80,000, right? So, and then at the same time, so this is the journal entry record sales. And then at the same time, we need to record the cost associated with those inventory. So Arlington should record cost of goods sold of 50. Is paying out cash of 80,000 and it is getting inventory 80,000. And when it is selling those inventory to the outside party for 100,000, it is getting cash 100,000, recognized revenue of 100,000. At the same time, it needs to transfer the cost of those inventories, which are 80,000. So it should recognize cost of goods sold for 80. Cost of goods sold for 80,000 and to record the decrease in its inventory for 80,000. So that is Zirkin's journal entry. And if you view Arlington and Zirkin as one firm, what should be its journal entry? So if you view Arlington and Zirkin as one firm, what it essentially did is it purchased the inventory for 50,000 and it sold the inventory for 100,000. So the journal entry is it gets 100,000 when sell the inventory, and that is recognized as the revenue for the firm. And then the cost associated with that is 50,000. So 50,000 decrease in inventory. So we look at, we have the Arlington's book and we have Zirkin's book. We have all of those journal entries made on the two firms' book. And now we need to get it as if the two firms is one firm. So we need to get all of this into this. So what should we do here? First, let's look at the cash account. This 80,000, Arlington recognized 80,000, while Zirkin paid out 80,000. So those two 80,000 cancel out. And this 100,000 recognized by Zirkin is what should be recognized if we view two firms as one firm. So nothing should be done here regarding to cash. The cash account is correctly stated. And then let's look at sales. For sales, on Arlington's book, it has recorded 80,000 sales to Zirkin. On Zirkin's book, it is recording 100,000 sales to outside party. But if we view two firms as one firm, the first 80,000 shouldn't happen. So the only thing that should happen is the second 100,000, the sale to the outside party. So sales here is obviously it is overstated by 80,000. And to reverse this, we need to debit 80,000 sales. The next cost of goods sold. On Arlington's book, we record 50,000 cost of goods sold when Arlington sold those inventory to Zirkin. On Zirkin's book, it is recording 80,000 cost of goods sold when Zirkin sold those inventory to the outside party. But the real cost, if you view two firms as one firm, the real cost associated with those inventory is only 50,000. The cost that Arlington purchased that inventory initially. So the second 80,000 is obviously it is redundant. So in order to reverse this 80,000, we credit 80,000 cost of goods sold. For the inventory account, on Arlington's book, it is recording should be recorded, so which is the initial 50,000. So inventory is correctly stated here. So inventory is correctly stated here as well. So as you see here, in order to get, starting from two firms book, a separate book, in order to get to as if two firms are one firm. So the journal entry we need to make here is we need to debit sales for 80,000, credit cost of goods sold for 80,000. And this journal entry, this debit sales 80,000, credit cost of goods sold 80,000. This is our consolidation entry TI. So this is an example of if all of the inventories are sold externally. Let's look at another example. The second example is what if all of the inventories remain within the firm at the end of the year? So the same example, we have Arlington and Zirkin. Arlington made 80,000 inventory sale to Zirkin. Arlington acquired inventory for 50,000, and Zirkin did not sell any of the inventory externally. So all of the inventory remain within the firm. Still, the 4 questions, please take 15 minutes, try to work on those questions, and you can pause your video for now. So we have 2 firms, Arlington, Zirkin, and we have Arlington plus Zirkin. First of all, what is the general entry on Arlington's book? On Arlington's book, when it sold inventory to Zirkin, it debit cash 80,000, credit sales for 80,000. And then at the same time, it is debiting cost of goods sold for 50,000, credit inventory for 50,000. So this we already talked about just now. And then on Zirkin's book, Zirkin bought those inventory at 80,000. So it spent cash 80,000, and then inventory increased by 80,000. And it hasn't sold any inventory to outside party. So that's it for Zirkin. And if you look at 2 firms as one combined firm, the firm actually didn't make any sale during the current period. So nothing should be recorded. And then how do we transfer? We take Arlington's book and Zirkin's book. So we have this, and how can we transfer to Arlington and Zirkin as one firm, which means that no journal entry should be made. So let's first put in the entry TI, which we did before. Entry TI, so obviously here sales is overstated. So we put down sales by 80,000, and then for cost of goods sold, cost of goods sold go down by 80,000. So cash account, Arlington when it made a sale, it gets 80,000 cash. When Zirkin is in this transaction, Zirkin paid out 80,000 cash. So cash cancel out. And there's nothing that needs to be done with regard to cash. For sales, when Arlington made a sale, it is recording 80,000 sales of inventory. But actually, if you look at two firms as one firm, no sale has been made. So to reverse this overstated sale, we already have TR entry. So debit 80,000. For cost of goods sold, when Arlington made the inventory sale, it is recording cost of goods sold for 50,000. And then when we use the TR entry to reverse it, we reverse it by 80,000. So we obviously over reversed it. And then to put it back, we need to put it back by 30,000 to make it as if no cost of goods sold occurred. So we need to, after we credit cost of goods sold for 80,000, we need to debit it by 30,000 again using another journal entry. Inventory account. Arlington, the original cost of the inventory is 50,000. But when it is selling the inventory to Zirkin, those inventory, obviously, it gets to be revalued to 80,000. So inventory now is kind of appreciated, even though nothing happened, but the inventory is kind of appreciated by 30,000. And we need to bring that down, that 30,000 inventory down. So this debit cost of goods sold for 30,000, credit inventory for 30,000, this journal entry is called your journal entry G, the G entry. So this is the second situation. And now let's look at the last situation, which is a portion of the inventory remains. So those three examples are mutually exclusive examples, right? So if you have sold everything, if you have sold nothing, sold 60,000 of those go to outside party, which means that 20,000 still remain within the firm. And then please take 15 minutes, try to work on those four examples, those four questions, and you can pause your video for now. So again, we have Arlington, we have Zirkin, and we have Arlington plus Zirkin. So the same as before, Arlington made 80,000 inventory sale to Zirkin. So cash increased by 80,000, sales increased by 80,000, and cost of goods sold increased by 50,000. Inventory decreased by 50,000. That is what Arlington recorded on its book. For Zirkin, it bought the inventory for 80,000. And also it has sold 60,000 of those inventory at whatever price. Let's just assume the selling price is X. So it gets cash of X and it is recording sales of X. At the same time, it is recording the cost associated with those inventory that has been sold. So cash goes up by X and it can recognize X of sales. Cost of goods sold. Cost of goods sold is cost of goods sold associated with the 60,000. So we have sold 60,000 out of 80,000 inventory. And then, but the original cost, the cost which should be is 50,000. So we just need to scale it to the 50,000, the original cost of those inventory. So out of this 50,000, so that means the cost of goods sold that should be recognized for if you view two firms as one firm is cost of goods sold 37.5 and inventory goes down by 37.5 thousand. So this is if you view two firms as one firm. And we have Arlington, we have Zirkin, and we want to get to as if two firms is one firm. Cash here cancel out. And then this X equal to that X. So cash is correctly stated. There's nothing that needs to be done with regard to cash. With regard to sales, so this X is this X. And then sales, because Arlington recognized 80,000 when it sell to Zirkin. So sales, if you combine two, if you just take A's firm and Z's yeah, sorry. So I need to write it again. So yeah, please take another some time to work on it on your own. I need to rewrite everything. Okay, so first of all, cash, there's no problem with cash. We don't need to do anything. For sales, we need to put it down by 80,000. So the TR entry, debit sales, 80,000. And then the other side is credit cost of goods sold for 80,000. And then let's skip cost of goods sold for now. Let's look at inventory, which is easier. Oh, actually, none of them is that easy. So let's just still do cost of goods sold first. Cost of goods sold, Arlington recorded 50, Zirkin recorded 60, and the TR entry take out 80. And we need to get to 37.5. So how much should we do here? We need to add back, in order to get from here to here, we need to add back another 17.5, right? So we debit cost of goods sold for 7.5. And the inventory account, Arlington recorded negative 50, Zirkin plus 80, negative 60. And then we need to get to negative 37.5. So in order to get from here to here, we need to take out 7.5. So this journal entry, debit cost of goods sold for 7.5, credit inventory 7.5, that is our G entry. A little bit more sense to you, like intuitively. So if you think about the search, if you think about the search situation, the inventory transfer when only part of the inventory has been sold to the outside party at the end of the financial reporting period, the search situation can actually be viewed as the combination of two parts, right? The first part is, so here we have Arlington and Zirkin. So the first part is Arlington. So here, this if you go back to look at the example the third example was Arlington made 80,000 sale to Zirkin. The original cost was 50,000, and Zirkin sold 60,000 to the outside party. And then, so this can be decomposed into the first situation is Arlington sold 60,000 inventory to Zirkin, and all of the 60,000 has been sold to the outside party. And then the second one is Arlington sold 20,000 to Zirkin, and Zirkin didn't sell anything to the outside party. So this is example 3. So in other words, example 3 can be decomposed into example 1 and example 2, right? So with regard to, So with regard to example 1, so yeah, this is basically the total is 80,000 sales, cost of goods 50,000. It can be decomposed into 1, all has been sold, and the cost of goods sold associated with this 60,000 inventory that has all been sold is 37.5 thousand. The profit associated is 22.5 thousand. The remaining is 20,000. Cost of goods sold associated with this 20,000 is 12.5 thousand. The profit associated is 7.5 thousand. So for the sold part, if you remember what we did in example 1, we only have one consolidation entry TI. We just need to reverse all of the overstated sales and cost of goods sold, which are 60,000. And for the example 2 part, for the remaining part, we need to reverse the overstate. For that part, if none has been sold, we need not only to reverse the overstated inventory, we also need to reverse the overstated profit, which is associated with that inventory. So this is the TI for the second one. So we need to first reverse the overstated sale, which is 20,000. And then we need to reverse the overstated profit, which is 7.5 thousand. So if you combine these two entries as one entry, you basically get sales 60 plus 20, it is combined into 80,000. Cost of goods sold 60 plus 20 is combined into 80,000 as well. So these two entries derived here using this method. So, or in other words, you can either do you can either derive it yourself, write down the parent's journal entry, the subsidiary's journal entry, what it should be, and then figure out what consolidation entries we need to take in order to make it as if two firms is one firm. Or you can just do the shortcut way. So the shortcut way is basically, it can be viewed as a situation of all sold, which has nothing to do with, there's no profit that needs to be reversed. And the only profit that needs to be reversed is the profit that is associated with the inventory that has not been sold. Or in other words, it is this part, the 7.5 that needs to be reversed. And then, so this is basically the G entry, the number we put in the G entry. And this is the number we put in the TR entry. The whole amount of sales and cost of goods sold, we need to reverse it. So let's look at another practice now. This is a very simple practice. So firm A made $100 inventory sale to firm B. The cost of inventory is 80. Firm B sold 60 to outside party. What are the consolidation entry TI and G to eliminate intra-entity inventory transfer? Please take 5 minutes. Try to work on this example on your own. You can pause your video for now. So the total intra-entity inventory transfer, the total sales is 100. The total cost of goods sold is 80. So the total profit, if everything has been sold, that is 20. And then how much has been sold? 60 has been sold. What is the cost associated with this 60? So the cost associated with 100 is 80. So the cost associated with 60 is 48, and the profit associated is 12. The remaining, how much remain within the firm? 40 remain within the firm. And the cost associated with the remaining inventory is 32. The profit associated with the remaining inventory is 8. So if we just do the shortcut way here, the journal entry is basically we debit sales 100. So this number, credit cost of goods sold for 100. And then we need to eliminate we need to defer the intra-entity profit associated with the inventory that has not been sold at the end of the financial reporting period. So this is TI. And consolidation entry G is to debit cost of goods sold for 8, credit inventory for 8. Yeah, so that's it. So that is consolidation entry TI and consolidation entry G. And in the next class, we're going to talk about consolidation entry star G.